Nebius just posted a $582 million quarter, revenue up 454% year-over-year, and the stock jumped double digits. This is what Nebius actually does, who it's really competing with, and where it says it's headed next. On August 12, 2026, Nebius reported second quarter revenue of $582.3 million, beating analyst estimates, with AI cloud revenue up 514% year-over-year. Adjusted EBITDA flipped from a $21 million loss a year earlier to positive $236 million. Annual recurring revenue hit $3 billion, up nearly 600%. The company also closed 4 AI cloud deals this quarter, each worth over $1 billion. Shares jumped double digits. But a great quarter doesn't explain what this company actually is, or why it's suddenly landing billion-dollar deals other clouds aren't. Nebius is a publicly traded AI cloud company, headquartered in Amsterdam, trading on the Nasdaq as NBS. It has around 1,800 employees, a market cap around $49 billion, and $8 billion in cash on hand. That's a strikingly small headcount for a company running some of the largest GPU clusters in Europe and the US. This isn't a sprawling hyperscaler. It's a lean, focused infrastructure company. Nebius runs a full-stack AI cloud. Compute, in the middle, NVIDIA GPU clusters, from Hopper through the newest Blackwell Ultra systems, orchestrated through managed Kubernetes, with object and block storage underneath. On top of that, AI Studio, a managed model platform, Token Factory for inference and fine-tuning, and Tavily, a search and grounding layer built specifically for AI agents. None of it exists in isolation. NVIDIA sits above it as both an investor and an infrastructure partner, $2 billion in, 5 gigawatts committed through 2030. And 2 anchor customers, Microsoft and Meta, have already committed a combined total approaching $45 billion in future spending. Raw compute, a software layer on top of it, and 2 of the biggest names in AI already locked in as customers. Here's how Nebius actually got here. February 2022, its predecessor, Yandex, gets suspended from Nasdaq after Russia invades Ukraine. July 2024, Yandex sells off all of its Russian assets for $5.2 billion, the largest corporate exit from Russia on record, and reorganizes its remaining international business as Nebius Group, refocused entirely on AI infrastructure. Nebius resumes Nasdaq trading that October. By early 2025, it's building out data centers in New Jersey and Iceland. September 2025, Microsoft signs on for $17.4 billion of capacity through 2031. March 11, 2026, NVIDIA invests $2 billion directly into Nebius. Weeks later, a new 310-megawatt AI factory in Finland, and Meta signs on for up to $27 billion over 5 years. Then, August 12th this year, the earnings beat. 2 years, almost to the day, from selling off its old business to closing $4 billion AI deals in a single quarter. So what does Nebius say comes next? For all of 2026, guidance points to revenue of $3 to $3.4 billion, annual recurring revenue of $7 to $9 billion, and capital spending of $20 to $25 billion, with a contracted power target just raised to 5 gigawatts by year-end. Starting in 2027, it plans to deploy more than 1 gigawatt of new capacity every single year. Beyond raw compute, it's scaling Token Factory, its inference and post-training service, and growing Tavily, its search and grounding tool for AI agents, toward 2.5 million developers. It's also rolling out real-time capacity auctions, letting price float with demand instead of locking in a flat rate. And by 2030, its NVIDIA partnership alone commits to 5 gigawatts of deployed systems. The through line, less reliance on any single mega contract, more products layered on top of the raw GPUs. So how does Nebius actually stack up? CoreWeave is roughly 10 times its size in raw GPU count and sits in a higher tier on independent industry rankings. Lambda Labs competes hard on price and simplicity. And the hyperscalers, Amazon, Microsoft, Google, offer far more than just GPUs. Nebius doesn't outmuscle any of them on scale. Its edge is the balance sheet. CoreWeave carries roughly $50 billion in total liabilities against just over $2 billion in cash, and pays over $1 billion a year just in interest. Nebius holds more cash than debt, funded heavily by customer prepayments, 50 to 60% upfront on its billion-dollar deals, not by loans. It also designs its own server racks in-house, a holdover from its Yandex engineering roots, And NVIDIA is both an investor and a hands-on infrastructure partner. The advantage isn't more chips. It's not needing to borrow to buy them. CEO Arkady Valas put it simply on the earnings call. We choose when to sell, to whom we sell, and on what terms, and how we finance everything. That's a deliberate contrast with competitors racing to lock in capacity however they can get it. The catch: that discipline requires demand to keep outpacing supply. If AI spending ever cools, the same prepayment model that looks conservative today gets a lot harder to keep filling. One question worth answering directly: does Nebius actually build data centers, or just rent space in someone else's? It builds. New Jersey, scaling toward 300 megawatts. A co-location site in Keflavik, Iceland, and a 310-megawatt AI factory in Lappeenranta, Finland, one of the largest dedicated AI compute sites in Europe. It even designs its own server and rack hardware in-house, a holdover from Yandex's original infrastructure team. This is real physical build-out, not a reseller layer on top of somebody else's cloud. What actually makes the NVIDIA relationship unusual? Two things stacked together. NVIDIA put $2 billion directly into Nebius as an investor in March 2026. But it's also an operating partnership. Nebius is designated an NVIDIA exemplar cloud partner, meaning its infrastructure is built and validated against NVIDIA's own reference architecture, with the two collaborating on AI factory design and fleet management. NVIDIA has a financial stake in Nebius succeeding, and Nebius gets engineering access most customers simply don't. You'll hear Nebius called a neocloud. Here's what that actually means. It's a newer breed of cloud provider, built specifically around GPU-dense compute for AI training and inference, instead of the hundreds of general-purpose products a hyperscaler like Amazon or Google offers. Neoclouds are narrower, but often faster to deploy the newest chips, and priced more aggressively for AI workloads specifically. CoreWeave, Lambda Labs, Crusoe, and Nebius are the names that come up most. So what actually separates Nebius from the other neoclouds? Not scale. CoreWeave has roughly 10 times the GPU count. Its financial structure and heritage. CoreWeave carries about $50 billion in liabilities against roughly $2 billion in cash, and grows mostly on debt. Nebius is net cash positive, funded largely by customer prepayments instead of loans. It also inherited 2 decades of infrastructure engineering from Yandex, not a 2- or 3-year-old startup stitched together from rented hardware. And it has a deeper software layer on top of the raw compute. That combination, not chip count, is the actual edge. So which is it? The financially disciplined neocloud built to outlast this cycle, or a smaller player still one bad quarter away from the leverage race it's avoided so far? Comment your take below.